Hello, I'm Warren Burkholz. I'm a loan officer at South Pacific Financial in Marietta, California. Today, this is part 4 of 5. We'll be looking at the effect of interest rates on foreclosures and should buyers and sellers wait. And even though agents and buyers and sellers sometimes think we need a crystal ball to imagine what the Fed's doing with rates and what the impact will be, there's actually a better way. Let's look at the 75-year history of 30-year fixed mortgage rates. And we're using the 10-year bond to do that. In prior sessions we discussed why this works, but basically if you look at the 10-year bond and you apply to it a kind of a layer of icing on a cake, sort of an adder to these rates, in the amount of about 1.5 to 3.5%, depending on the exact type of loan and the borrower's criteria, you can have a very precise predictor of what rates will be for that buyer-borrower loan program into the future based on forecasts for the 10-year bond and what rates were in the past, and you can compare them. And that's what we're doing here. So what's really important is what is the effect of rates on housing prices, and for that we can use the U.S. Census Bureau. We can use a common metric, that being the value of the dollar in the year 2000, and apply it to each decade's average that the Census Bureau provides over time, and lay that over what was going on with interest rates, so you get a direct comparison. Here you can see that housing values went up fourfold consistently, despite the fact that interest rates were increasing 10 or 15-fold in some cases, and furthermore continued to increase as rates plummeted after 1981. So most of your buyers and sellers and borrowers have never been in a world where rates were steadily increasing. They've only known times when rates were dropping, where you could wait and refinance later, get a lower rate. This wasn't the case for 4 decades prior to 1980, where rates continually increased. So what happened in 2007 and 8? What caused that crash? Certainly wasn't the fact that rates were rising, because rates had been dropping for 20 years prior, a quarter of a century prior. The rates were dropping, and yet we had a crash in 2007. What is going on, and how will this affect what's happening here in the future? Well, specifically in the Inland Empire, we have the information from the University of California, Riverside. The University of California, Riverside publishes this information periodically. This is their chart for what was going on in the first decade of 2000 when the crash occurred, and in subsequent years. But to look at that and make sense out of it in terms of what caused the crash, we really need to look at what was going on with foreclosure rates, which they handily provide as well. This is a direct comparison of foreclosure rates during that same time, month to month, during the crisis and subsequently thereafter. Since that time, we've seen that foreclosure rates have even dropped further. They're now at the lowest historic rate, about less than a third of 1%, 0.3%. And more importantly, delinquency rates, which are a precursor to foreclosure rates, have been actually dropping. They are at an all-time low, but they dropped in 2017 to 2018, July to July. They dropped from 1.5% to 1.1%. This information provided by the IE Business Daily and CoreLogic. So what does this mean for the average transaction that we have out there? As rates are increasing, what I'm showing here is the effect of increasing rates and at the same time decreasing values and prices and loan amounts for the same property, the same transaction, the same down payment. Everything's the same. The only thing that changed is I'm showing about a 3% drop in values and loan amounts over a 12-month period as we plug in the nominal rate increases that had occurred in the last year. And what we see here is that actually housing costs, the price of owning a home, has gone up during this time frame, even though prices had dropped. In fact, We need to see a 6% decline in real estate values to keep the payment at par, given that the rate of interest rate increases. So, summing all this up, basically, it's our contention that your buyers and sellers are going to be experiencing a world much more like the 1950s, 50s and 60s, and possibly 70s, at a time when rates, the 10-year was averaging more around 4% and mortgage rates were around 6%, and that hopefully we can maybe see a little more stability as the Fed eases the rate of increase of interest rates, but that essentially, if your buyer in particular is waiting for interest rates rising to drop prices, it just isn't a history of that, and the foreclosure and serious delinquency rates are not supporting that concept. But there may be times of periods where rates drop after being rising rapidly. They may drop rapidly, and there could be opportunities there. So, real estate professionals, if you are interested in a mastermind group dealing with things like interest rates and other maybe adverse conditions that could be made an opportunity, let's get together and talk. Thank you.